Welcome to the deep dive, where we really try to cut through the noise to get to the core of what matters for you. If you've ever, found yourself staring at stock charts, maybe trying to figure out why some companies seem to just shoot upwards while others, well, they just sort of fizzle out, you are definitely not alone. The financial markets can feel like a bit of a labyrinth, right? Full of factors, theories, gut feelings, especially when everyone seems to have a different hot take on what really drives success. But what if the answer isn't just about fleeting investor mood or market sentiment? What if it's something much more fundamental, something rooted, deeply in the actual economic fabric of the companies themselves? Today, we're plunging into a really fascinating piece of research that tackles this exact question head on. It's called investment-based expected stock returns. And this isn't just any paper, it's a pivotal 2009 work published in the very highly regarded Journal of Political Economy, written by Laura Chalais Liu, Tony M. Whited, and Lu Zhang. Our mission in this deep dive is to unpack how a theory rooted in the core investment decisions of firms, what economists call Q theory, can predict stock returns. We'll also see how it stacks up against the models you might already know, like, say, the CAPM, the capital asset pricing model, or maybe the Fama French three-factor model. Think of this as your shortcut, maybe, to understanding the surprising power of corporate investment in predicting market behavior. It could give you a whole fresh lens to view your own investment thinking.
Yeah, and what makes this research so compelling and, frankly, pretty groundbreaking is this big shift in perspective it represents. Most traditional asset pricing models, they often start by looking at investor preferences, what makes investors tick, what risks are they willing to take on, how do they value future consumption. This paper, though, it pivots dramatically. Instead, it explores how a company's real economic decisions, its strategic choices about capital investment, like when should we build, when do we expand, what new equipment do we buy, and crucially, how do we finance those investments? How these things directly influence and actually reveal deep insights into its future stock performance. It's a powerful sort of production side view of asset pricing. It moves us away from purely demand side, investor-centric explanations and gets us closer to the actual economic activities that generate value within the firm. It's about the tangible stuff, the assets, the strategic choices, not just market psychology.
That's a really crucial distinction. Okay, so let's unpack this core idea right from the get-go. Q theory and how it applies, maybe surprisingly, to stock returns. At its heart, Q theory puts forward a rather elegant, almost, intuitive idea. It says that under certain ideal conditions, things like what economists call constant returns to scale, which just means a company can double its output if it doubles all its inputs. Well, under those conditions, a firm's stock returns are directly equivalent to its levered investment returns. Okay, but what does that really mean for you as an investor?
Well, put simply, it means the returns you get from owning a piece of a company, through its stock, are intrinsically tied to the returns that company earns from its actual business investments. So if a company, for example, invests wisely in a new production line, and that capital generates fantastic returns for the actual business, then you as a shareholder should expect to see good returns on your stock too. Now, this basic idea, it actually has historical roots going back to Brainard and Tobin in the late 60s. But it was really John Cochrane back in the early 1990s who championed its more direct and, let's say, rigorous application to understanding the cross-section of stock market returns. He kind of moved it from just pure corporate finance theory into the world of asset pricing.
Right. And this is where it gets really interesting because, as you say, it's not just a handy assumption. It's like an algebraic restatement of something fundamental in corporate finance theory, formalized by James Tobin, right? It connects marginal Q with average Q. Can you break those down for us a bit?
Absolutely. So think of marginal Q as the market's valuation of the very next dollar a firm is thinking about investing in capital. Like if a company's deciding, should we buy one more machine or should we expand the factory by one more square foot? What's the market's price tag for that extra bit of productivity? If marginal Q is high, it means the market sees a lot of value in that additional investment. It's basically a signal saying, yeah, go ahead, invest more. And this is then linked to average Q. Average Q is the total market value of all a firm's existing assets divided by what it would cost to replace them today. So it's kind of the market's overall valuation of the whole existing capital base compared to rebuilding it from scratch. Hiyashi's work back in '82, it formalized this deep structural link, suggesting that under certain conditions, these two Qs should actually be equal. And that provides a really powerful theoretical basis for guiding a firm's investment decisions.
And this focus, on a firm's optimal choices and its actual characteristics, it really marks a fundamental departure from those traditional consumption-based models. that rely so heavily on assumptions about investors and their preferences. Here we're looking directly at the company's actions, its economic engine, not just the investor's psychology.
Okay, so if stock returns are, under these conditions anyway, equal to these levered investment returns, then we definitely need to understand what those levered investment returns actually are. It sounds complex, but the paper breaks it down, right, into sort of tangible building blocks from the company's financials.
It does, yeah. The levered investment return, that's equation 4 in the paper if you're following along, is basically a weighted average of two things: the firm's stock return and its after-tax corporate bond return. Simple enough. But to really get the essence, you need to understand the unlevered investment return first, which is in equation 3. This unlevered return is essentially the ratio of the marginal benefit of investing at some future point, let's call it time plus 1, to the marginal cost of investing right now at time p. And the key thing is, this isn't some abstract theory. It's made up of very concrete elements you can actually find or at least derive from firm's financials and its operational choices. That gives the model a really solid grounding in, actual economic activity.
Okay, walk us through those concrete elements then. What exactly goes into calculating this benefit versus cost ratio?
Sure. Let's break down the numerator first. That's the marginal benefit of adding one more unit of capital. It includes a few key pieces. First, there's the marginal after-tax profit that this extra unit of capital produces. So you buy a new machine. How much extra profit after tax does that machine kick out? That's a direct measure of its economic contribution.
Makes sense.
Second, there's the marginal after-tax reduction in adjustment costs. Now, firms face very real adjustment costs when they invest. It's not free. Think about, retooling a factory, maybe retraining staff, getting permits, or just the disruption of installing new equipment. The model recognizes these frictions. So if adding a unit of capital now helps streamline things and reduce those future adjustment costs, that's a benefit. Third, the marginal depreciation tax shield. This is a big one. As assets like machines and buildings wear out, companies can deduct that depreciation from their taxable income. That deduction acts like a shield, lowering their tax bill. It's a direct financial incentive the tax system provides for investing in long-term assets.
Right, yeah.
And finally, there's the marginal continuation value of that extra unit of capital, net of depreciation. Basically, what's its future value to the firm after you account for wear and tear?
So yeah, these are all factors derived directly from a firm's actual financial reports and its operational choices. It keeps it grounded.
So, okay, rather than just looking at a stock price bouncing around or trying to guess investor sentiment, which, let's face it, can be pretty fickle, we're drilling down into the nuts and bolts of the company's actual economic engine. It's like the market is rewarding companies based on how smart, how effective their spending on growth really is. It's about fundamental value creation, not just hype.
That's a great way to put it. Yeah, that makes a lot of sense. Okay, now to put this theory to the test, the researchers couldn't just, use a simple spreadsheet. They needed a pretty robust econometric toolbox, right? Some sophisticated statistical methods to sift through all this data.
That's absolutely right. Yeah, they employ a powerful statistical technique called Generalized Method of Moments, or GMM. Now, GMM, it might sound like a highly technical mouthful, but its core purpose here is actually quite elegant. It helps us see if the theoretical predictions of Q theory hold up when you compare them to actual market data, even when reality is, a bit messy. The main goal for the researchers was twofold. First, to see if, on average, expected stock returns actually equal expected levered investment returns. That's equation 6 in the paper. And second, to figure out if the stock return variances, the volatility, equal the levered investment return variances, which is outlined in equation 7.
Okay, so GMM is basically a sophisticated way to connect theory with actual, sometimes imperfect data. It's looking for a robust average fit, even if things don't match up perfectly every single time because of, say, measurement issues or model simplifications. Sounds like a pretty pragmatic approach.
That's spot on. Yeah, the power of GMM isn't improving a perfect, moment-to-moment match. That would be an impossible standard for any model, really. Instead, it lets us test these weaker conditions and expectation. Since the model isn't expected to hold literally for every stock at every moment, that's just unrealistic. GMM lets them check if these relationships hold on average. They define what they call model errors, specifically, an expected return error, they call it key, and a variance error, 2J, in equations 8 and 9. These errors just capture the differences between the model's predictions and what actually happened. And the crucial assumption is that these errors, on average, should be 0. This approach is used a lot in finance because it's pretty robust to various real-world data challenges like, difficulties in measuring capital stock precisely or figuring out the exact form of investment adjustment costs. It allows for a rigorous but still pragmatic test.
Right. And when it comes to testing financial theories, researchers often group stocks together, don't they? This study used 30 testing portfolios, not individual stocks. They had 10 for standardized unexpected earnings, SUE, 10 for book-to-market, BM, and 10 for corporate investment, CI. Why is focusing on portfolios so critical here instead of just looking at individual companies?
Yeah, that's a really important methodological choice. Using portfolios offers several big advantages for this kind of research, especially when you're trying to find systematic patterns. Firstly, the key cross-sectional patterns that finance academics are often trying to explain, things like the value premium or the size effect, are typically observed and analyzed most clearly at the portfolio level. Individual stocks can be super volatile due to company-specific news, which would just obscure these broader trends. Secondly, portfolio returns inherently have lower residual variance than individual stock returns. By grouping lots of stocks together, a lot of that idiosyncratic noise, the unique, unpredictable ups and downs of a single company, it just gets diversified away. This smoothing effect makes the statistical analysis more reliable. It helps you separate the real systematic effects from just random firm-specific movements.
Got it.
And thirdly, at the firm level, investment data can be pretty lumpy. A company might make a huge investment one year, buy a whole new factory, and then almost nothing the next. That's due to what we call non-convex adjustment costs. But aggregating up to portfolios smooths out this lumpiness, giving a more stable and representative picture of investment behavior across similar types of firms. Oh, and the authors also equal-weighted their portfolio returns. That's actually a tougher test for asset pricing models compared to valuating because it gives smaller companies an equal say in the averages. It stops the huge companies from dominating the results.
Interesting. So let's dive a bit deeper into these specific portfolios. They're the testing ground, as you said. Can you give us a bit more detail on each type, starting with SUE?
Sure. The 10 SUE portfolios, standardized unexpected earnings, they're designed specifically to capture how the market reacts to earnings surprises or, shocks to earnings. SUE is calculated as the change in a company's quarterly earnings per share from 4 quarters ago, divided by the standard deviation of those earnings changes over the prior 8 quarters. That calculation is key because it standardizes the surprise, making it comparable across firms of different sizes and volatilities. Stocks are then ranked monthly based on their SUEs and put into one of 10 portfolios using NYSE breakpoints that keeps the sorting method consistent. These portfolios are then held for 6 months. That period is chosen to capture both the immediate market reaction and any subsequent drift after an earnings announcement. The sample periods for these ran from January 1972 to December 2005. So basically, the researchers were looking at how quickly the market prices in these earnings surprises and whether Q theory could explain the return patterns that go along with them.
Okay, and the book-to-market, the BM portfolios, that's the classic value versus growth sort, right?
Exactly. The 10 BM portfolios are based on book-to-market equity. And BM is, well, arguably one of the most important stylized facts in the cross-section of returns. It famously shows the value premium, the observation that value stocks often outperform growth stocks. To build these, stocks are sorted annually at the end of June. The sorting is based on NYSE breakpoints for book equity, which is basically common equity plus deferred tax divided by the market value of equity from the previous December. This annual sorting ensures the portfolios reflect changes in firms' value or growth characteristics over time. Equal-weighted annual returns are then calculated from July of year 10 to June of year T plus 1, and they rebalance annually. The sample for these went from January 1963 all the way to December 2005. And typically, high BM stocks are seen as value stocks. Market value is low relative to book, while low BM stocks are growth stocks. Market is optimistic about future growth. And finally, the corporate investment, the CI portfolios. You mentioned these are particularly critical for this study.
Yeah, the 10 CI portfolios are super important because the whole Q theory framework is fundamentally about characterizing optimal investment behavior. So theoretically, this is where the model should really shine. Stocks are sorted annually, again at the end of June. This time, it's based on a measure of capital expenditures scaled by sales, but benchmarked against a prior 3-year moving average of capital expenditures. This sorting variable, CIT1, helps identify firms that are investing heavily compared to their own recent history or size. Like the BMM portfolios, they calculate equal-weighted annual returns from July of year C to June of year T plus 1, rebalancing each June. And the sample period is also January 1963 to December 2005. So you can see these portfolios were all carefully constructed to highlight different well-known patterns of stock returns, providing really diverse testing grounds for the Q-theory model.
Okay, so this isn't just theory floating around. It's grounded in mountains of real company data from CRSP and Compustat. But as anyone who's tried to work with financial data knows, it can be really tricky, right? Full of nuances, timing issues, missing bits. How do they make sure everything lined up correctly and actually reflected the firm's real economic activity? Precision here must have been absolutely critical.
Oh, absolute paramount. Precision in measurement and, just as importantly, meticulous timing alignment are crucial in this kind of empirical work. You get that wrong, the whole analysis falls apart. So the data comes primarily from CRSP for stock returns and Compustat for the company financials. They applied specific filters to ensure data quality. For instance, they dropped firm year observations if they were missing key data like total assets, gross capital stock, debt, or sales, or if those numbers were negative, which doesn't make sense. They also focused only on firms with a December fiscal year end, just to keep things consistent and comparable. And they left out regulated firms and financial firms, mainly because the Q-theory framework isn't as directly applicable to their unique capital structures and investment rules.
Makes sense.
Then, they meticulously defined each variable using specific Compustat item numbers. For instance, capital K was defined as gross property, plant, and equipment. That's Compustat item 7. It's the total historical cost before depreciation. Investment was calculated as capital expenditures, item 128, minus sales of property, plant, and equipment, item 107. If that sales number was missing, they just set it to 0 to be conservative. So it measures the net change in physical assets.
Okay.
Output Y was simply sales, item 12, total revenue. Total debt B summed up long-term debt, item 9, and short-term debt, item 34. They even did some robustness checks using a more complex way to estimate the market value of debt, similar to what Bernanke and Campbell did, and reassuringly found similar results.
Good.
Market leverage, W, was the ratio of total debt to the sum of total debt plus the market value of equity, a key measure of financial risk. And the depreciation rate was calculated as the depreciation amount, item 14, divided by the capital stock, item 7. Gives you a per-unit measure of wear and tear.
So it's not just grabbing numbers, it's a really careful construction of these key economic variables. But what about the timing? That seems like it could easily trip you up.
Precisely. Timing is absolutely critical. You've got to avoid any look-ahead bias and make sure the variables are genuinely predictive. The model needs beginning-of-period stock variables and flow variables measured over a year to line up correctly with the annual stock returns. So for annual stock returns calculated from, say, July of year 2 to June of T+1, any beginning-of-period stock variable, like capital K, had to be taken from the balance sheet at the end of year T1, like the December 1992 balance sheet if T was 1993. And any flow variable measured over the year, like investment I, had to come from the income or cash flow statement for year T, the 1993 statement. This meticulous alignment ensures that the investment returns calculated for a specific year are matched with stock returns over the exact same forward-looking period. And this also involves aggregating these firm-specific characteristics up to the portfolio level. For instance, summing up the sales of all firms in a portfolio and dividing by the sum of their capital stocks to get a representative portfolio-level measure. It's detailed work.
Yeah, sounds like it. What about things like corporate bond returns? Is that data easy to get for all firms?
That's a practical challenge. Firm-level corporate bond data is often quite limited. Lots of firms don't have bond ratings or publicly traded bonds. So, to tackle this, the researchers imputed bond ratings for firms without them. They used an ordered probit model based on observable characteristics like interest coverage and leverage. Once they had an imputed rating, they assigned corporate bond returns from Ibbotson Associates based on that rating category. And for the corporate tax rate, they used the statutory corporate income tax rate, which averaged a hefty 42.3% over their sample period from 1963 to 2005. Interestingly, they even tried experimenting with more complex firm-specific tax rates, but the results were largely similar. That kind of underscores the robustness of their findings and suggests the statutory rate was a decent enough proxy for this model. It really speaks to the rigor they applied.
Okay, so the groundwork was meticulously laid, data carefully cleaned and aligned, portfolios constructed. The first step then was to put the reigning champions of asset pricing to the test, right? To establish that benchmark. Before we get to how Q-theory did, it's really important for us to understand the playing field. How well did these well-known models, the ones often taught in finance classes, actually explain the returns of these specific portfolios?
Precisely. We need that clear benchmark to really appreciate what Q-theory brings to the table, or doesn't.
The paper compared its performance against 3 established models that many listeners will probably recognize. First, the Capital Asset Pricing Model, or CAPM, probably the most fundamental, widely known model out there. It explains expected returns based only on a stock's sensitivity to the overall market, its beta. The idea is investors only get paid for systematic market risk. Higher beta should mean higher expected return, according to CAPM.
The class.
Yep. Second, the Fama-French 3-factor model. This was a big step up from CAPM, developed by Eugene Fama and Kenneth French. It adds 2 extra factors to CAPM, one for firm size, small minus big, SMB, capturing the small cap effect, and another for value, high book-to-market minus low, HML, capturing the value premium. This model explained returns much better than CAPM did.
Right, the workhorse model for a long time.
Exactly. And third, the standard consumption CAPM. This one takes a broader macroeconomic view. It links returns to aggregate consumption growth and investors' preferences for risk and timing. The theory is that investors demand higher returns for assets that do poorly when consumption is low, basically, assets that are risky in bad economic times.
Okay, 3 big contenders. Now for the moment of truth. How did these traditional foundational models actually do when tested against these 30 specific equal-weighted portfolios? Did they explain the patterns?
Well, here's the critical finding that really sets the stage. They largely fell short, across the board actually, which creates a compelling need for something like Q-theory. Let's break it down by portfolio type. For the SUE portfolios sorted by earnings surprises, remember there was that stark increase in average returns from 10.9% for the low surprise group to 23.4% for the highest. That's a huge 12.5 percentage point spread. But volatility was pretty flat around 22%. The traditional models just failed to capture this. The CAPM error for the high minus low SEE portfolio, the bit the model couldn't explain, was a massive 12.6% per year.
Wow.
Fama-French did even worse, with an error of 14.1%. And the consumption CAPM had an error of 13.4%. The average error across all 10 SUE portfolios, the mean absolute error, or MAE, was between 3.6% and 5.7%. And crucially, the statistical test formally rejected all 3 models. They just couldn't capture the SUE effect. If you look at scatter plots of their predicted returns versus the actual realized returns, the lines are basically horizontal, meaning they predicted almost no difference in returns, even though there was a huge difference in reality.
So if you as an investor were relying solely on these traditional models, you would have completely missed the boat on the big returns coming from companies with those positive earnings surprises. You just wouldn't understand that key driver. That's a really big miss.
Exactly right. Now, moving to the BM portfolio's value versus growth. Again, the traditional models really struggled. Value stocks, high BM, earned way more, 25.8% per year, compared to growth stocks, low BM, at only 8.7%. That's a massive 17.1% difference per year, the famous value premium. Volatilities were similar, around 27%. CAPM predictably produced an enormous 18.6% error for the high minus low BM spread. But what's really revealing is that even the Fama-French model, which includes a BM factor specifically designed to capture this premium, still showed a significant 7.3% error for these equal-weighted portfolios. It couldn't fully explain these returns.
Even Fama-French, okay.
Yeah. And the consumption CAPM had a 12.3% error. Again, all 3 models were statistically rejected. It really highlights how hard it is, even for multi-factor models, to really explain some of these persistent anomalies, especially when you use equal weighting, which, as we said, is a tougher test.
Right. And the last set, the corporate investment portfolios.
The trend continues. For the CIA portfolios, remember, high investment stocks actually earned lower average returns, 15.2%, than low investment stocks, 22.1%. That's a negative 0.0% difference, the investment anomaly. Both CAPM and Fama-French showed an aggregate 6.3% error for this high minus low CI spread. Consumption CAPM was at 8 and 8.4%. And you guessed it, all were rejected by the statistical test. The traditional models just couldn't explain why firms that invest heavily tend to have lower subsequent stock returns. It suggests their frameworks are missing something fundamental about the economics here.
This truly sets the stage perfectly for our Q-theory deep dive. It's clear the established models, despite being widely used, are consistently missing the mark on some really significant, well-documented market effects. That leaves a big gap in our understanding. So as we pivot to Q-theory, what's really striking is how it tackles this challenge with such parsimony. It seems so simple compared to the complexity we just discussed. The Q-theory approach relies on estimating just 2 core parameters. How does something seemingly so simple manage to grapple with such complex market behavior?
That's an excellent point, and you've hit on one of its real strengths. The parsimony is truly remarkable, especially next to those multi-factor models. This Q-theory model, in its core setup for this study, only needs the estimation to two parameters. A, which is the adjustment cost parameter, and alpha, which represents capital share in the firm's production function. That's it. And this simplicity is powerful because it suggests that maybe these fundamental economic drivers, captured by just these two values, can explain a whole lot of what's going on without needing lots of extra factors.
Okay, and what did the estimates for those parameters look like? Did they make economic sense?
They did. The estimated capital share, alpha, typically range from 0.2 to 0.5 across the different portfolio tests. And that range is entirely consistent with loads of prior economic research on how much of a firm's output goes to capital versus labor. So that lends real-world credibility to the model structure. And the estimates for A, the adjustment cost parameter, were consistently positive. That's crucial. It implies that firms face increasing in context costs when they invest. Think about it intuitively. Buying one new computer is easy, right? But buying 1,000 and integrating them all, that gets exponentially harder and more costly.
Yeah, definitely.
So this positive, A, validates that underlying economic assumption there are real-world frictions. You can't just instantly adjust your capital stock. Firms can't just snap their fingers and double the size of their factory without incurring significant costs. It ensures the firm's optimization problem have a practical, sort of interior solution, not just an all-or-nothing choice. This parameter also tells us something about the elasticity of investment with respect to marginal Q, basically. How much a firm's investment changes when the market's valuation of new capital changes.
Okay, so armed with these two economically grounded parameters, how did Q-theory actually perform when asked to match the expected returns of our portfolios? This is where things started looking pretty good, right?
This is indeed where Q-theory really started to shine, especially in this first test, where the model was asked to match only the expected returns, just the averages, setting aside volatility for a moment. For the SUE portfolios, the mean absolute error, the MAE for Q-theory, was just 0.7% per year. Now, to really appreciate that, remember the errors we just talked about. CAPM was 5.7%, FOMA French 4.0%, consumption CAPM 2.6%. Q-theory blew them away.
Huge difference.
Huge. It indicates a vastly closer fit to the actual observed returns and a much better explanation for that earnings surprise anomaly. And crucially, unlike the traditional models, Q-theory was not rejected by the statistical tests here. That's a massive win for an investment-based approach. For the CI portfolios, those sorted by corporate investment, Q-theory again dramatically outperformed its rivals. If MAE was 1.5% per year, compare that to CAPM's 5.7%, FOMA French's 2.2%, and consumption CAPM's 1.8%. And again, the model was not rejected here either. This provides really compelling evidence that a firm's investment behavior itself is a fundamental driver of these returns, effectively explaining that investment anomaly where the others failed.
Okay, two big wins. What about the book-to-market portfolios, value and growth?
For the BM portfolios, the model's performance was a bit more modest, with an MAE of 2.3% per year. Now, this is pretty comparable to FOMA French, which had 2.8%, and consumption CAPM 2.4%. But it still significantly beat the basic CAPM, which had a 6.3% error. What's particularly noteworthy here is that even without explicitly building a value factor into the model like FOMA French does, Q-theory provided a strong economic rationale for understanding the value premium, rooted in investment decisions. And importantly, it was not formally rejected here either.
So, okay, in 2 out of the 3 major categories, a model based purely on a company's fundamental investment behavior delivered significantly better predictions for average stock returns than the leading alternatives. Even outperforming models specifically designed to capture some of those effects, like FOMA French for value. That's a really powerful statement, isn't it? A big aha moment, perhaps, for people used to just thinking in terms of factors.
It really is. And to make it even clearer, the study looked at the individual portfolio errors and provided some really compelling visual evidence. For that high minus low SUE portfolio, that big spread between the best and worst earnings surprises the expected return error for Q-theory was only 0.4% per year, almost nothing, especially when you remember the huge 12% to 14% errors from the traditional models, and Figure 1A in the paper shows this visually. The Q-theory model's predicted returns line up beautifully with the realized returns along that 45-degree line. It's a stark contrast to the flat lines you see for the traditional models, which basically predicted no spread at all. It's like the traditional models saw a flat plane, while Q-theory actually saw the mountains and valleys in the data.
That visual really drives it home.
Yeah. For the BM portfolios, the high minus low error was 1.2% per year. Now, the individual errors for the extreme growth and value portfolios were a bit larger than for SUE, but they didn't vary systematically with BM. And crucially, that 1.2% error is still way smaller than the traditional model's errors. Remember, 7.3% for Fama French, up to 18.6% for CPM. So even if the overall fit wasn't quite as perfect as for SUV, Q-Theory still captured the spread between value and growth much better. It provided a fundamental reason for the value premium.
Okay.
And for the corporate investment portfolios, the CI ones, the high minus low portfolio, had an error of just negative 0.5% per year. That means the model accurately generated that large negative spread between low and high investment firms. And Figure 3a again reinforces this, showing a strong alignment with the 45-degree line, highlighting its superior predictive power where the others failed. So yeah, the visual proof, see how closely the Q-Theory predictions track reality for average returns? It makes a profoundly strong case for its explanatory power.
It really does. But okay, this isn't magic, right? There have to be specific economic forces, specific gears turning inside the model based on the firm's decisions. How does it do that? What are the specific levers within a firm's investment choices that are driving these predictions? And what can you, the listener, learn from them?
That's an excellent question, and it really gets to the beauty of a structural model like this one. It doesn't just tell us that it works, it tells us how it works. It gives us clear economic mechanisms. The intuition comes straight from the components that make up the investment return and the levered investment return equations we talked about earlier. Essentially, the differences in average stock returns across firms are driven by several tangible, measurable factors related to their investment and capital structure. Let's tick them off. First, there's the marginal benefit of investment, which is mainly about the marginal product of capital. The logic is pretty straightforward. All else being equal, firms that have low sales to capital tomorrow, meaning their existing capital isn't generating much revenue, suggesting new capital won't in cement. Either those firms should logically earn lower average returns. The market kind of anticipates this inefficiency.
Okay, lower productivity, lower returns. Makes sense.
Second, investment growth matters a lot. This part is roughly proportional to the growth rate of the firm's investment, kind of like a capital gain for the firm itself. So if a firm has lower expected investment growth, it should lead to lower average returns because the company isn't expanding its productive capacity as much. Its future earnings power looks weaker.
Right. Less growth, less return potential.
Third, and this one is really critical, investment to capital. Okay, investment today is an increasing function of the net present value, the NPV, of new capital projects. Now, if a firm has a low cost to capital, that means the NPV of new projects looks high, which incentivizes high investment today. Therefore, and this is key investment today, and average stock returns are negatively correlated. High investment today tends to predict lower average returns tomorrow.
Wait, that sounds counterintuitive. High investment means lower returns.
It does sound it at first, but think of it this way. If a company is investing heavily today, it implies that its cost of capital, which is essentially its expected return required by the market, must be low to make all those projects look attractive from an NPV perspective. So high investment signals a low required return. And relatedly, since investment goes up when marginal Q, the market's value of new capital, is high, and marginal Q is inversely related to book to market, well, this framework also predicts that expected returns and book to market should be positively correlated. That gives us an economic explanation for the value premium.
Okay. That connects the dots.
Fourth, the depreciation rate D matters. If a company's assets wear out faster, if it has higher rates of depreciation tomorrow, that implies lower average returns. Why?
Right.
Because its productive capital base is eroding faster, meaning it needs more investment just to stay in the same place.
Right. Running faster just to stand still.
Exactly. And fifth, market leverage, W. This is about financial risk. Expected stock returns should increase with market leverage today. That's more straightforward. Leverage amplifies equity returns, both good and bad. So, more highly leveraged firms should, all else equal, offer higher expected returns to compensate shareholders for that extra financial risk.
Okay, so here's the powerful takeaway for you, the listener. Q-Theory suggests a company should earn lower average stock returns if it has characteristics like high investment to capital today, low expected investment growth, low sales to capital tomorrow, high depreciation rates tomorrow, or low market leverage today. That's a really comprehensive, economically intuitive set of insights. It goes way beyond just simple correlations and gets into the why.
Yeah, and to really nail down which of these mechanisms are doing the heavy lifting for different types of firms, the authors did something they called expected returns accounting. It involved these comparative static experiments where they isolated the role of each component. For example, they'd take a characteristic like investment to capital, IK, and set it to its cross-sectional average value for all the portfolios, basically neutralizing its unique variation across them. Then they'd rerun the model and see how much bigger the errors got. This lets them see precisely how much of the model's predictive power for, say, the SUE effect is actually driven by variations in IK versus variations in investment growth and so on.
That sounds like a forensic analysis, like taking apart an engine to see which specific parts are crucial for making it go fast, or for handling corners well. What did they find? Which parts mattered most for each portfolio type?
Exactly. And the results, which are laid out in Table 4, Panel B of the paper, they reveal some really fascinating and quite distinct drivers across the different portfolio types. It's not one size fits all. For the SUE portfolios, the most important component driving returns by a long shot was investment growth, which they denote as QQ. When they shut down its explanatory power by fixing it to its average, the Q-theory model suddenly underpredicted the average return of the high minus low SUE portfolio by a huge 8.9% per year. Remember, the original error was tiny, only mega 0.4%.
Wow, that's massive.
It really is. Future sales to capital, YK, also played a significant role. Fixing that caused a 4.3% error. This strongly suggests that earnings surprises are deeply tied to the market's anticipation of future growth opportunities and how firms are expected to capitalize on them through investment. Now, for the BM portfolio's value and growth investment to capital, IK, and market leverage were both absolutely critical. Get this. If you remove the explanatory power of IK by fixing it to its average, the model's error for the high minus low BM portfolio jumps by a staggering 90.2%.
90%.
90%. It's not just a number. It screams how absolutely fundamental a company's actual investment decisions are in defining its value or growth identity in the market. It's much more than just what's on the balance sheet. It speaks directly to the real-world costs and strategic importance of adjusting capital, making the investment decision a primary driver of the value premium. Fixing market leverage also caused a big error, 11.6%. Sales to capital and investment growth were actually less important here.
Incredible. And for the CI portfolios.
For the CI portfolios, sorted by corporate investment, the dominating force driving returns was again investment to capital. IK. Removing its variation created an error of negative 8.5% for the high minus low CI portfolio, highlighting its central role in explaining the investment anomaly. Investment growth QQ and market leverage W also contributed significantly, causing 4.6% and 2.7% errors respectively if they were neutralized. Sales to capital, YK, interestingly, had almost no effect here. So these results clearly show that different economic forces are driving the return patterns across different firm characteristics. It's not a single explanation, but this dynamic interaction of specific components tailored to each portfolio type gives us a much richer, more granular insight into why these well-known patterns exist, way beyond just observing a correlation.
Okay, so after proving its mettle, and pretty impressively in predicting average returns, the researchers then, as you said, upped the ante even further. They moved to a much tougher test, asking the Q-theory model to simultaneously match both the expected returns and the variances, the volatility of these portfolios. It's one thing to predict the average, what a stock might do on average over time, but it's a whole other challenge to predict the wild swings, the ups and downs, the riskiness of those returns, right? This feels like where a model really has to prove its structural integrity, tackling both reward and risk together.
That's exactly right. It's a much higher bar. And impressively, the model performed remarkably well in reproducing the observed volatilities. The average predicted volatilities were really quite close to the average realized volatilities across all three sets of portfolios. For SUE portfolios, the model predicted 20.4% volatility versus 21.1% actually observed, almost dead on. For BM portfolios, it was 23.6% predicted versus 25.0% realized. Still very close. And for FI portfolios, 24.4% predicted versus 24.8% realized. Again, remarkably close. And importantly, the statistical test indicated the model was not rejected on its variance predictions alone. That's a significant achievement and really speaks to the model's structural soundness.
That's genuinely impressive. Getting the average right is one thing, but getting the riskiness right too, the magnitude of the swings, that feels like a different level of understanding what's going on under the hood.
Right.
Almost like predicting not just the average temperature, but also how much it's likely to fluctuate day to day.
It is a significant leap, yeah. Especially when you think back to earlier work, like Cochrane's 1991 paper, which found that aggregate investment return volatility was only about 60% of the market's volatility. This study improves on that dramatically, partly by explicitly accounting for leverage, which we know significantly boosts equity volatility compared to asset volatility. Also, by using portfolios where firm-specific shocks aren't completely diversified away like they are in the aggregate market, and by formally choosing the parameters, Arrow and Alpha, to help match variances rather than just calibrating them from outside sources, it achieves a much more realistic match to the observed volatilities we actually see in the market. It shows the model's core economic structure captures not just expected value, but also the inherent riskiness of a firm's investments.
Okay, but there's often a catch, isn't there? While matching the volatility was successful, the paper notes that the expected return errors, that MAE, generally got quite a bit worse compared to when the model only had to match expected returns. So is there a trade-off here? When the model has to juggle both balls, does the accuracy of predicting the average return suffer?
Precisely. There is an inherent trade-off when you impose more constraints on any model, and this increase in expected return errors is somewhat anticipated. The model is now trying to satisfy more conditions at the same time, specifically for the SEUE and CI portfolios, where the underlying drivers like investment and output are naturally much less volatile than stock returns themselves. The joint estimation procedure basically you have to push for larger estimates of the adjustment cost parameter A and capital share, alpha. This was necessary to generate enough volatility in the predicted investment returns to match the high volatility of actual stock returns. But these larger parameter estimates, while great for fitting volatility, unfortunately couldn't simultaneously produce the same small expected return errors that were achieved when only expected returns were the target. So yeah, it led to a deterioration in the accuracy of the average return predictions for those SUE and CI portfolios.
Okay, that makes sense. It's trying to hit two targets, and sometimes you land closer to one than the other.
Exactly. And there was another nuance too. The model's volatility predictions, while good on average, didn't perfectly match the pattern of volatility across portfolios. In the actual data, stock return volatilities didn't show a clear, consistent relationship with firm characteristics like SUE or BM. High SUE didn't always mean higher or lower volatility, for instance. But the Q-theory model, when estimated jointly, predicted a negative relationship between volatility and SUE, you can see this in Figure 4a, and a positive relationship between volatility and BM, Figure 4c. So while it got the average level right, it predicted patterns in volatility that weren't actually there in the data. That highlights a subtle area where the model could still be refined.
Got it. So let's take a closer look at those expected return errors when the model was doing this double duty, matching both averages and volatilities. What did that mean for its ability to explain the return spreads we cared about?
Well, under this tougher simultaneous matching, the results for expected returns definitely took a hit for some portfolios. For the SUV portfolios, the expected return errors now varied systematically across the deciles. They went from middle net of 7.0% per year for the lowest SUE group up to plus 5.4% for the highest SUE group. That difference, 12.4%, is now unfortunately pretty comparable in size to the errors we saw from the traditional models like CAPM and Fama French, and Figure 4b shows this visually. The scatter plot of predicted versus realized returns becomes largely horizontal again, much like we saw for the failed traditional models. It indicates a significant loss of predictive power for the SUE return spread when forced to also match volatility.
Ouch. Okay, what about BM?
For BM portfolios, the errors were definitely larger than in the expected returns only case, but the model still managed to predict an 11.3% average return spread between the extreme value and growth portfolios. The high minus low error itself was 5.9%. Now, while bigger than before, that was actually still better than the 7.3% error from the Fama French model. So even with the added constraint, it held its own reasonably well for value versus growth.
It's better. And CI.
For the CI portfolios, however, the paper states the model's performance in reproducing average returns deteriorates the same level as in the traditional models. The difference in errors between the extreme high and low CI portfolios was minus 6.6%, a magnitude very similar to the errors from CAPM and Fama French. And again, Figure 4 shows largely horizontal scatter plots, indicating the model really struggled to predict the average return spread for investment portfolios when constrained to also match volatility accurately.
Okay, so the Q-theory model seems to have a definite sweet spot. It's incredibly powerful, maybe even revolutionary, for predicting average returns based on a company's real investment behavior, especially for those tricky SUE and CI effects where others fail. But when you ask it to hit both the average and the volatility targets perfectly at the same time, some of that impressive predictive accuracy for the average returns can fade, particularly for SUE and CI. It's a testament, I suppose, to just how complex the market is, that maybe no single model gets everything perfect in every dimension. But it's crucial to understand where its real strengths lie in explaining those average return patterns.
That's a very fair summary, yes.
Now let's turn to an even loftier goal.
Beyond matching averages, beyond matching volatilities, the Q-theory model, if you take it literally in its most pure ideal form, actually predicts an even stronger relationship. It predicts that stock returns should be perfectly correlated with these levered investment returns, like at every single data point, not just on average, but moving in perfect sync, almost like a mirror image. That's a huge claim.
It's a very strong prediction, yeah. And it's precisely here where the study uncovered a really intriguing disconnect, something we could call the correlation puzzle. What they actually found was that the contemporaneous time series correlations, looking at stock returns and levered investment returns happening in the same period, were surprisingly weakly negative. For example, pooling all the observations for the SUV portfolios, that contemporaneous correlation was modestly 0.1. Not large, but statistically significant at the 5% level. So in the short term, they actually tended to move slightly in opposite directions.
Okay, that's weird.
But here's the fascinating twist. The correlations between one-period lag stock returns and current levered investment returns were, in contrast, positive. For those same SUE portfolios, this lagged correlation was 0.2 and highly significant at the 1% level. So let's recap that. Stock returns and investment returns tended to move in opposite directions at the same time, but earlier stock returns actually predicted later investment returns moving in the same direction. It definitely seems counterintuitive at first glance.
That's a real head-scratcher. Negative correlation now. Positive correlation if you look back a year. What on earth is going on there? Does this correlation puzzle mean the model is fundamentally broken, or is there some deeper explanation?
No, not at all, actually. This intriguing lead-lag pattern, it's described as being consistent with the evidence in Table 5 of the paper, and it can be explained quite elegantly by a very real-world phenomenon, investment lags, something Peter Lamont highlighted back in 2000. It's not a failure of the theory at all, but rather a crucial reflection of real-world frictions. It reflects the inherent time delays in corporate decision-making and actually executing big projects. Firms simply don't, and often can't, adjust their investment plans instantaneously when financial market conditions or discount rates change.
Okay, so how does the lag explain both the negative and the positive correlations?
Let's think through a typical one-year lag, just to make it clear for you. Imagine that in year 2, the market's discount rate for a firm's future earnings falls. What happens? Well, future earnings are suddenly valued more highly, causing the firm's stock price to rise in year 2. That rise in stock price signals to the firm, hey, the market likes new investments now. But firms typically need time, sometimes a whole year or more, to actually plan, get approvals, and then physically execute new investment projects, like building a factory or installing new machinery, so they can realistically only increase their actual physical investment spending starting in year 2 plus 1. That dynamic right there explains the positive one-period lagged correlation. A rise in stock returns in year 2 is followed by a rise in investment growth in year 2 plus 1. Stock prices lead real investment.
Okay, that makes sense for the positive lagged correlation. What about the negative contemporaneous one?
Right, so that same discount rate fall in year yet means that future expected returns are now lower going forward into year T plus 1. Why? Because prices already jumped up in year T to reflect that lower discount rate. The future expected return from today's higher price is now lower. So this period of lower expected future returns in year T plus 1 coincides with the high investment growth happening in year T plus 1, as the firms are now executing those projects they planned back in year T when discount rates fell. This simultaneous occurrence, lower expected returns and high investment growth happening in the same period, T plus 1, is what creates that negative contemporaneous correlation the study observed. It's like this dynamic dance between fast-moving financial markets, which price in new expectations very quickly, and the slower, more deliberate pace of real corporate investment decisions. So it's not a flaw in the theory, it's actually a powerful insight. It adds another layer of dynamic understanding to the investment-return relationship and confirms that capital adjustment in the real economy isn't instantaneous. It shows the market looks ahead, but firms operate with real-world delays.
Fascinating. Okay, so wrapping this all up, what have we ultimately uncovered in this deep dive into the Q theory of investment? It feels like quite a journey. We've seen that a remarkably parsimonious model, one built just on a company's fundamental investment and financing decisions, can deliver some incredibly powerful insights. It seems it can. significantly outperform traditional asset pricing models, even complex multi-factor ones, when it comes to explaining average stock returns for portfolios sorted by earnings surprises and corporate investment. And it performs pretty comparably for value and growth stocks, too. It offers clear, economically intuitive mechanisms. It links tangible firm characteristics like investment growth, sales to capital, leverage, directly to expected returns. It really helps tell us why these factors might matter, not just that they seem to correlate.
Right.
It can also remarkably match observed stock return volatilities when challenged to do so. Though, as we discussed, this can sometimes involve that trade-off, potentially weakening the accuracy of the average return predictions for some specific portfolios like SUE and CI.
Yeah, that trade-off is important.
And finally, it reveals that fascinating yet explainable lead-lag pattern in correlations between stock returns and investment returns, reflecting those very real-world investment adjustment lags that separate market sentiment from actual boots-on-the-ground economic activity.
Absolutely. I think ultimately this deep dive really shows us that firms, on average anyway, seem to be making pretty rational investment decisions that are broadly in alignment with their cost of capital, as perceived by the market. And this alignment, or perhaps more interestingly, the discrepancies or the lags in that alignment, seems to be a powerful driver of many of these well-known patterns we see in cross-sectional stock returns. And while the model doesn't explicitly try to model investor preferences or psychology, its singular focus on the production side of the economy, on what firms actually do, offers really robust, economically intuitive insights into why certain stock characteristics matter for returns. It pushes us beyond just observing correlations or thinking about behavioral biases and gets us into the bedrock of corporate economics. It's a powerful reminder that fundamental business decisions are deeply, profoundly linked to what happens in the stock market.
So if a company's investment plans, its real economic choices about building factories or developing new products, can tell us so much about its future stock returns. Maybe here's a final thought for you, the listener. What might your own long-term investments, not just financial, but maybe in your skills, your health, your relationships, and even your daily spending choices reveal about your personal cost of capital or your own future financial or personal well-being? What big investments are you making in yourself, your career, or your finances today that you expect will pay off? Or maybe potentially underperform in the future? Something to think about until our next deep dive.